we are covering the complex topic of virtual currency and cryptocurrency taxation. The single most important concept the exam will test is that the IRS treats virtual currency as property, not as a foreign or domestic currency. This single fact drives all of the tax consequences. Forgetting this is the most common trap candidates fall into. When you treat it as property, every transaction becomes a potential taxable event, similar to selling a stock. Let's walk through an exam-style scenario. A taxpayer purchases 1 unit of a cryptocurrency for $10,000. 2 years later, they use that same unit to purchase a car with a fair market value of $70,000. The exam will ask you to determine the tax consequence. The trick wording here makes it sound like a simple purchase. However, the taxpayer has actually disposed of property. They have a realized gain of $60,000, which is the $70,000 value of the car minus their $10,000 basis in the cryptocurrency. Since they held the asset for more than a year, this is a long-term capital gain. This gain must be reported on Form 8949 and then carried to Schedule D. The exam will test your knowledge of this flow. Another heavily tested area is the digital asset question located right on the first page of Form 1040. The question asks if the taxpayer engaged in certain transactions involving digital assets during the year. The exam will give you a list of activities and ask which ones require the taxpayer to check the yes box. Simply buying virtual currency with US dollars and holding it is not a reportable event that requires a yes. However, selling it, exchanging it for other property or services, exchanging it for another cryptocurrency, or even receiving it as a payment for services all require checking yes. Now let's consider income from mining. A taxpayer who successfully mines a cryptocurrency must recognize income equal to the fair market value of the mined coin on the date it was mined. The exam question will focus on the character of this income. If the taxpayer is engaged in mining as a trade or business, which is determined by the level of regularity and continuity. This income is reported on Schedule C and is subject to self-employment tax. If the mining activity does not rise to the level of a business, it is reported as other income on Schedule 1. The amount of income recognized becomes the taxpayer's basis in the mined coin. If they later sell that coin for more than its basis, they will have a separate capital gain. The exam will try to confuse these two taxable events: the initial ordinary income from mining and the subsequent capital gain or loss from its disposition. To remember the core concept, use this phrase: crypto is property, not pocket change. Every time you use it, you aren't just spending, you are selling property. You must first calculate the gain or loss on that sale before considering the item you acquired. This mindset is crucial for navigating exam questions that will try to disguise a disposition as a simple everyday purchase. Accurate record-keeping of dates and values is critical, as basis tracking is essential for correctly calculating the gains or losses the exam will ask you to identify.